Hi, I'm back. We were explaining the factory overhead budget, and I was talking about the twofold view that we have to take of cash flow versus GAAP income. Okay, the reason for that is because cash comes into a company from places other than sales. Okay, so right away there's a disparity between the income statement and a cash flow statement. Secondly, there are many, many ways cash leaves a company, more than it comes in, unfortunately. And there are some ways that cash leaves a company besides the paying of expenses. So for that reason, again, we have to have that double vision of looking at GAAP income for accounting purposes and cash flow for, let's call it, treasury purposes. I'm a cash kind of guy, so I will look at cash more times than not compared with an income statement because, well, GAAP has its set of problems as well. Okay, so one of the most common differences between GAAP income and cash flow income, so to speak, is depreciation. Why is that? Because depreciation, which is in factory overhead, by the way, that's what we're talking about here, depreciation is a non-cash expense. Think back in basic accounting, we learned that you pay for a capital asset one time. That does involve cash, obviously. But when do you write it off? You don't write it off immediately. Okay, you write it off as you use it, and that could take you many years. Every year, with a stroke of the pen, you create expense. You increase expense, writing off a piece of equipment, a little bit of it anyway, and what we're doing is diminishing the value of the asset. Okay, it's a bookkeeping gimmick. It does not involve writing a check. You don't write someone a check for depreciation. You do for your utility bill, your payroll, your materials. All of those other expenses, insurance, rent, the works, generally involve writing a check. Cash does leave the company. Not so with depreciation. There are others as well, but since depreciation is common to almost every business, that's the one I've picked on here. The factory overhead budget is going to involve listing every single expense other than direct materials and direct labor, right? Including depreciation. We're going to separate them by fixed and variable, as I described at the end of my last lecture. All right? So, for Copland, I've kept it to only a few expenses for each of those categories. Obviously, even for a small startup company, there will be many, many, many expenses under these two categories. But here I've kept it to four. Okay, first I list my variable expenses. Now, where did these numbers come from? Well, I pressed people into service in my company in various departments, working in teams to come up. I involved engineers, I involved manufacturing people, facilities people, to come up with their best projection of what my costs will be for the coming years, quarter by quarter. Okay, and this is what they have. And remember, I'll be judging these people, and they're retaining and holding to these numbers, or beating them, hopefully. Indirect material, indirect labor. Now, that's not direct material or direct labor, remember, but I'll let you look back at your old managerial accounting textbook for the distinction between those. I threw in maintenance and I threw in utilities. I made them all variable. In other words, the expense will fluctuate with volume of production. That's what makes a variable expense variable. I total them up, as you can see. All right, now remember, I am just making these numbers up. This is an example. I list all my variable expenses and I total them. Then I say, okay, which ones are fixed? My insurance will stay the same, regardless of the volume of production. I have to pay $200,000 for the whole year, no matter what. Depreciation, ooh, remember that number. Okay, that's going to stay the same. It's just a write-off. Lighting is going to stay the same, and my rent will be $80,000 a quarter. I do a total. Notice it is the same every single quarter, right? It's a fixed expense. It might change. I might add advertising later in the year. That's fixed. But I'm holding the numbers steady for the whole year, okay? All right, then I combine my variable and fixed lines, and that gives me this line right here. In dollars, thousands of dollars actually, that's my total overhead expense for the income statement. That's going to go on the income statement. I've highlighted it in yellow. Okay? Now the problem is I'm also going to have to do a cash flow statement, a budgeted cash flow statement, and that number is going to be different because the income statement has to include depreciation. That's a legitimate GAAP expense. But we don't consider depreciation for cash flow forecasting purposes because no one writes a check for depreciation. It's a bookkeeping gimmick. So I back out my $55,000 per quarter from my initial total. I pull it out, and the total overhead for cash flow purposes, forecasting purposes, I've put in green. You can see that it is different by $220,000. Okay? What are other examples of things that will be in my cash flow budget that you will not see on your income statement? How about buying that machine that we're depreciating in the first place? How about selling a machine? That involves cash. It does not involve the income statement, directly anyway. How about borrowing money? You don't put that in an income statement. That creates debt. All right? But when you get the money in, it affects cash flow. When you pay that money back, part of it, that is going to not affect the income statement. That's paying back what you owe the bank. Part of it will affect the income statement. Interest, that's an expense. Okay, so I hope you're getting a good view of that double vision that we have to have when you forecast GAAP income for the income statement and cash flow for the cash flow statement. Two very different things. Okay, moving on. We now know, I'm not going to get into how we absorb overhead. That is really a little bit too far divorced from the mainstream of this curriculum, friends. But I will remind you, if you want more guidance on this, you can write to me, of course. I'll be happy to elaborate. But we have to have a means of absorbing overhead into what it is we make, in this case, pounds of chocolate. Okay, so what we're going to do to complete this cost card down here is we're going to use direct labor hours to absorb overhead. I can pick any means, any reasonable means to absorb overhead that I like. In this case, I like direct labor hours. Many authors do as well. So if you're curious about the mathematics behind this, write to me. I'm not going to hold you responsible for this, but I want to point out that when you complete your manufacturing cost profile, you need to know what your overhead absorption, as we call it, is, in addition to your direct materials and direct labor. So here it tells you, and this is an important number, friends, it costs you a total of $4.41 of manufacturing cost, direct labor, direct materials, and factory overhead to make 1 unit of output, 1 pound of chocolate. Okay? You will need to know that, because when you budget, you need to know how to cost out your goods. Remember that second line of your income statement, cost of goods sold, right? Okay, when you know the total number of units you're selling, you need to know what the cost is to match it against the sales. Again, I'm not going to hold you responsible for this. I'm reviewing for you, for your convenience and to jog your memory, for your graduating and baccalaureate excellence here, how an income statement comes together. All right, please read this. And you know what, friends? If you have not reached the end of your matriculation with Dean, and if you have another couple of courses to go, including the capstone course, you might have to do some planning in that course. Keep this material. It will be handy. All right. Next, okay, we've done everything that has to do with that factory. The next step in the budgeting process, looking back at my matrix that I listed earlier in the chapter, is doing a selling and admin budget. Now, sales and administrative costs are not product costs. We don't add them to inventory. They operate kind of on their own. And in an income statement, they come after the line that we call gross margin. And I'll explain all that when we get to the income statement, friends. But the selling and admin budget, you can almost complete this one while all of the sales and production budgets are being prepared by our manufacturing geniuses. This one can happen on its own. But it's going to look an awful lot like our overhead budget. Why is that, friends? Because selling and admin, the cost of running our sales department and the cost of our executive administration at the top level, happens independently of our factory. At Dean College, I often say to my classes, live classes, we, right here, standing in this class, are the factory. Over at Dean Hall, where Dr. Rooney sits, that is the administration and sales office. What we do here is measured one way, what they do over there is measured in a different fashion. So the budget will be prepared. Some of the expenses will be variable, just like our overhead budget was in manufacturing. And some of them will be fixed. Hey, look, there's our old friend depreciation again. Okay? Let's keep that in mind because that represents not only for overhead, but also here for sales and admin, our only non-cash expense. So I'm going to total up my variable expenses and my fixed expenses. I put them in yellow to be consistent with my overhead budget. Those are the numbers we'll put into our income statement budget. Then I also simultaneously have to be thinking of a cash flow forecast or cash flow budget. So I'm going to pull depreciation back out again. And when I look at selling and admin for cash flow purposes, I'm going to use the numbers in green. All right? Very good. All right. Now, I'm going to speak briefly about the cash flow statement. Now, from this point on, friends, in cash flow, I'm not going to hold you responsible in this Business 325 curriculum for a budgeted cash flow, but I do, in all honesty, for your personal edification, have to mention it. Okay? So next thing we do in the natural order of preparing a set of uniform budgets is doing the budgeted cash flow statement. Why is that? The primary reason is because the cash flow statement tells you when you might fall short of cash throughout the year, and you will have to know when to borrow it. And when you borrow money, here it comes, when you borrow money, you must pay interest expense. And interest expense is a legitimate expense to go on your income statement. Therefore, you can't do an income statement until you do a budgeted cash flow statement. I gave you a whole bunch of assumptions. These assumptions are complex, so I'm not holding you responsible for them, but if you want to look at them, definitely retain these, please. And I'm going to make them available to you if you have any questions, because this will be a valuable device in your future. If not scholastically, then definitely professionally. Okay, so all of these assumptions will go into finalizing our uniform budgets, both the cash flow and the income statement, and the balance sheet too. Okay, read them on your own, please. You will not be seeing this on our final exam, but I will be asking you questions on the final exam about steps in preparing an income statement budget such as we've seen up to this point. Okay, friends? All right. Collections of accounts receivable. You all know from GAAP that when you sell something, it has to be put on your books as revenue immediately. That doesn't mean you're going to collect it. So there's a timing difference in between when you sell something and put it on your books as a sale and when you subsequently collect it, okay? That's what these next couple of schedules explain. I did one for receivables. I will not get into it, but read it on your own, please. And I hope you're interested in this because this is an asset that really adds a lot of intrinsic value to your resume. And you may feel free, of course, to keep this for your future reference. And keep my, please be sure to keep my personal contact information and send me an email if you ever have questions. I'll be happy to assist. I did something similar with payables because when you buy something and create the liability, that doesn't mean you're paying for it. So there's a difference between your income statement expenses and your cash outflows. All right. What else? All right, I pulled everything together here for a budgeted cash flow statement. As you can see, cash inflows come from primarily cash adjusted sales. All right, cash outflows from a cash perspective come from what we spend for the discharge of our payables, accounts payable. I went back to my factory overhead budget and I grabbed that line. Remember, this is a cash flow statement, so I didn't grab the yellow highlighted numbers, I grabbed the green ones. Those imported to here. Selling and admin, same thing. Don't grab the yellow numbers for the income statement, grab the green ones for cash flow. I grabbed direct labor as well. I put in some income tax assumptions. Let's assume that Copland is a taxable entity. And then I looked at net cash flows from operations. Based on the assumptions I gave you, I put in an assumption that we're going to buy $250,000 of machinery. That is obviously a cash outflow, but it does not affect our income statement directly. And all of this information in the financing section comes from all of these assumptions that I gave you way up here. Okay, study them please. If you're not really confident in how a cash flow operates, I hope that this chapter will be immensely enlightening to you. Okay, so we list the total increase or decrease in cash. Now cash is an ongoing thing, just like your checkbook, just like my checkbook. So I have our beginning cash balance. Where did this number come from? This number came from the balance sheet that I gave you right at the start of this whole mess, the 2012 ending balance sheet. That was our cash balance. So when you combine the increase or decrease in cash, you can see early in the year we lose cash, later on we make it up, and combine that with our running cash balance, that gives you your ending checkbook balance. And you'll notice that my ending first quarter balance becomes my beginning second quarter balance. All right, doing a cash flow, ladies and gentlemen, is as simple as that. Cash flows sound complex. They look tedious. But if you're systematic about it, they're extremely, extremely easy. If you don't believe me, read chapter 8, where I describe how to do a cash flow, because I discovered a secret about doing them that makes the whole process immensely simple. You'll have to trust me on that. Now, finally, we pull the income statement together. All right? I'm going to stop here, and I'm going to pull it all together for you in my fourth and final video. So stand by, please.